The repo market involves selling a security with an agreement to repurchase it later. The person that is selling the security is the borrower, and the lender is the person that is buying the security. Participants include banks, financial institutions, and sometimes central banks. As we will show later, central banks use the repo market to control the Fed funds rate. Repo lending is a form of secured lending, as the security sold is considered the collateral, and this ultimately reduces the credit risk. Repo typically consists of short-term transactions, often overnight. The repurchase price agreed upon at the outset, and the reason why repo market is important because it provides liquidity and short-term funding for participants in the financial markets. And let's now look at an example. Current US 5-year Treasury note is trading at a face value of USD 100 million. The buyer pays 100 million to the seller and takes delivery of the Treasury note. Remember that the buyer is the lender and the seller is the borrower. And the buyer, which is the lender, will take delivery of the Treasury note as a collateral. The terms of the repo has a 30-day maturity and is based on a 360-day year basis, as you will see later in the day count fraction in the calculation. The repo rate is 25 basis points per annum. To calculate the repurchase price, the lender is lending the $100 million for 30 days in this example. So to calculate the repurchase price, we first work out the interest for the 30-day loan. So we just multiply it by the annualized interest rate by 30 over 360. So 30 over 360 is also known as the day count fraction. So depending on the standard of the instrument, sometimes you would have 365 as the denominator. Anyway, so you add this plus 1 and you multiply by 100 million. This results in $128,833. Note that the repurchase price is higher than 100 million, and the difference will be the interest. Even though the buyer takes delivery of the security, the seller still retains the ownership of the security, which means that any interest payments during the repo term ultimately belongs to the seller. What the buyer earns is the repo rate on the transaction. Repo is short-term in nature, and typically they're just overnight, but they can have a maturity that is more than a day, as we have seen in the example earlier. The focus is on the liquidity because it is short-term, and because it involves high-quality securities, essentially very safe. The collateral is limited to highly liquid, low credit risk securities, such as sovereign bonds of various maturities. In the earlier examples, we see the US Treasury is one such example, and in that example is a 5-year maturity. But the security can be of any maturity. Transactions may reference a group of eligible securities rather than a specific security, and these are traded at a general repo rate. This repo rate is usually higher than a specific security because it is general. It is an advantage for the seller because it's easier for the seller to find the security to sell. So in order to compensate the buyer, the repo rate is usually higher. The reason why you see the word special is because sometimes security is very sought after, and because of that, it's considered a special security. And in that case, because it's highly sought after, the repo rate would be low because now the buyer can choose who to sell the security to, right? So in order for this buyer to get the special security, they would need to buy at a much lower rate. As for margin, participants in a repo contract usually agree on margining and other terms such as suitability of collateral and events of default. Okay, in terms of margining, this needs to be a haircut on the value of the security. And the collateral could also be substituted by another collateral during the term. So all these will be drafted in the master repurchase agreement. The way to calculate the initial margin is the following ratio, which is the security price at the time of the transaction divided by the purchase price. 100% margin signifies a fully collateralized loan, whereas a higher margin implies additional collateral protection beyond full coverage. If the purchase price is lower than the security price, repo is considered over collateralized, and this is an added protection for the buyer, which is the lender. The haircut of the underlying loan relative to the initial collateral value is calculated as follows. So we just find the difference between the security price and the purchase price and divide it by the security price. The higher the haircut, the more over collateralized the repo will be. The variable margin payment is equal to the difference between the current margin required and the security price at time t. So every day we can calculate the variation margin and determine if there is a need to borrower will need to post more collateral to the lender, or vice versa, the lender, if it's over collateralized based on the initial margin, lender will return some of the collateral back to the buyer. Looking at an example, using an initial margin of 102% and an initial bond price of 100 million, calculate the purchase price at t equals to 0. So in this case, we can just, if you look at the formula, 102% equals to the 100 million over the purchase price. And just bring the purchase price to the left-hand side will result in a price of 98 million-ish dollars. And the associated repo haircut can be calculated as this. It's 1.96%. You can see that this is close to 2%, but it's not exactly 2%, because the 2% is respect to the purchase price. We are calculating the haircut with respect to the security price. So the haircut is a little bit lower than 2%. We come to the repurchase price, which is a repo part. With the initial margin that we calculated, what this means exactly is that even though you're posting $100 million collateral, it will only be considered at a lower price of 98,000-ish. And calculating the repurchase price, we can see that the repurchase price is $8,059,641. So the difference between these two values would be the interest. But what happens if the price of the 5-year Treasury note rises to 103% of the security's face value? First, we calculate the purchase price 5 days after the trade inception. And this is the price at t equals 0 based on the initial margin of 102%. We calculate the new purchase price at t equals to 5 at this value. And the variation margin can be calculated by the initial margin multiplied by the new purchase price minus the security price at t equals to 5. And in this case, it's a negative value of about minus $3 million. Because the increase in the security price lead to an over collateralization of the loan by $3 million-ish. So this means that the lender will have to return approximately $9 million. There's a bit of a typo here, it should be 2.99. Financial market participants use the repo market for three general purposes. So the first one is financing the ownership of a security. Because if the market participant doesn't have the cash or doesn't want to spend the cash on buying the security, what they can do is they could buy the security and straight away repo the security out. And in that case, they would take the cash from the repo and would pay the seller. So usually, because if this is, for example, an overnight repo, the market participant is essentially just able to hold it for a day. So in order to continuously hold it. Either the market participant does a term repo for the duration of the period, or they could just roll over the repo every day. Another example will be earning short-term income by lending funds on a secure basis. So for example, if you think of a market participant as the excess cash that wants to lend out on a secure basis, so what they can do is they can go into a reverse repo. So a reverse repo is the other side of a repo. So the repo is seen from a borrower's perspective, and the reverse repo is seen from a lender perspective. So the lender would lend the funds and would take the security as collateral. Another way market participant does is to borrow the security by lending out the cash and then immediately sell the security short, betting that the security will go down in price. And when it's time to return the security, they will just buy it back from the market. Let's look at an example. An investor sells a bond to a bank's trading desk for cash. So what the bank could do is the bank can just pay the investor immediately, and this is just a pure bond purchase. Or the bank could borrow the purchase price from another bank, and the bank would deliver the bond in a repo transaction, so reducing its funding requirement to a fraction of the bond's purchase price based on the initial margin. So what this means is that the initial margin, the bank, if it's higher than 100%, the bank will get lesser cash of the bond. And the difference in the cash value will be the funding requirement for the bank to purchase the bond. As we have said earlier, central banks conduct monetary policy with repo as well. There are permanent measures of conducting monetary policy. Examples could be reserve requirements. These are amount of reserve that the commercial banks keep with the central bank every day to meet the minimum reserve requirements, or just the outright purchase and sale of securities. These are also known as the open market operations. But shorter term transitory measures uses the repo contracts. So what the central bank can do is it can temporarily increase cash reserves by borrowing securities, thereby lending out cash. So taking a short position in security, we have already talked about this. And from the perspective of the security buyer, a repo transaction or the cash lender, a repo transaction is often called a reverse purchase agreement or a reverse repo. So there's two sides of a repo. The borrower will see it as just a plain repo, and the lender will see it as a reverse repo. Repo transactions can be done by engaging a third party. If no third party is involved, it's known as a bilateral repo. So these are executed directly between the two parties. But this will result in credit risk. But for a tri-party repo, it involves a third-party agent for the transaction. This provides cost efficiencies because the collateral can be kept at the third party, and so there's no need for collateral to be transferred between the two counterparties. And also because if you trade directly with a third party, the buyer will have access to a larger collateral pool and also potential multiple counterparties. And also the third party also specializes in the valuation and safekeeping of the assets. So the role of a tri-party agent acts as a custodian or a clearinghouse and administers the transaction, which means that both sides will have to pay fee for the tri-party agent. So the role of a custodian is to safeguard and hold securities on behalf of clients. He also provides custody services such as safekeeping, asset servicing such as the coupon payment, and any corporate action, and also reporting. As for a clearinghouse facilitates the settlements of transactions between parties in financial market. So the settlement is the actual transfer of the cash and the security. So the clearinghouse acts as an intermediary to ensure that trades are completed smoothly and efficiently. So the clearinghouse also offers the service of verifying the terms of the contracts, ensuring that everything, the funds and the securities are exchanged. So this is the settlement part, and managing risks associated with market transactions. So the managing risk part is the daily margining that the clearinghouse would partake to ensure that the risk of default would decrease. So for example, if you see the earlier version of the variation margin example, if there is an increase or drop in the price of the bond, so each side will pay the other side on a daily basis. So this is also known as the daily margining. Types of settlement. There are two primary types of settlement. The first one is delivery versus payment, also known as the DVP. This is the most common settlement mechanism where the transfer of the securities occurs simultaneously with the transfer of the payment. So this ensures that the third party will ensure that the payment is only made when the delivery occurs. The clearinghouse will only deliver the securities only if payment is made. So in this case, both sides will have to trust the clearinghouse free of payment. In this case, securities are delivered without a simultaneous payment. This is less common, as you can imagine, because it's riskier and it usually involves additional agreements or guarantees.